if you're in your 50s holding Nvidia for steady dividend growth, or if you've built a chunk of your retirement income stream around semiconductor megacaps, what happens in the next 90 days will either confirm your strategy or force an unplanned portfolio adjustment that could cost you $5,000 to $10,000 a year in retirement income. Let's start with the core problem. $500 billion of Nvidia's $3 trillion market valuation, approximately 15% of the company's entire value, depends on revenue streams from China that have just become effectively impossible to access. This isn't speculation. This is documented in SEC filings, analyst reports, and confirmed through supply chain data. The size of the China exposure. Nvidia generated approximately $60 billion in total revenue in fiscal year 2024. Industry analysts, including those at Goldman Sachs and Morgan Stanley, estimate that China represents between 15–25% of Nvidia's direct revenue, translating to roughly $9–15 billion annually. But here's where the math gets scary for dividend investors. When you factor in indirect sales through intermediaries, contract manufacturers, and the broader ecosystem, some estimates place the true China exposure closer to 30–35% of total revenue. In 2023, before the most recent export restrictions tightened, Nvidia's China revenue was estimated at $12.3 billion. In Q3 2024, the company reported only $2.7 billion in China revenue, a 78% year-over-year decline. That's not a business headwind. That's a business decimation. For retirement income purposes, this matters because Nvidia's current dividend yield sits around 0.05%, essentially nothing. But investors have been holding Nvidia on the premise that the stock price would continue appreciating at 40–60% annually, creating capital gains they could harvest gradually during retirement. That assumption now rests entirely on the company maintaining its dominance in AI, without access to its second largest market. Why the export restrictions aren't going away. The U.S. Department of Commerce implemented export restrictions on advanced AI chips to China starting in October 2022, with subsequent tightening in October 2023 and February 2024. These restrictions came with detailed technical specifications designed to prevent companies like Nvidia from engineering workarounds. Understanding the enforcement mechanism is critical. The restrictions specify performance thresholds measured in floating point operations per second and memory bandwidth, not just company names. When Nvidia engineers an H20 chip specifically for the Chinese market, U.S. regulators don't simply ban the H20. Instead, they redefine the technical specifications that trigger export control, forcing Nvidia back to the drawing board. This is happening because of geopolitical reality. The Biden administration, and likely any successor administration, views advanced AI semiconductor dominance as a national security priority, equivalent to nuclear weapons during the Cold War. Deputy Commerce Secretary Don Graves stated in congressional testimony that these restrictions are designed to be resilient against product redesigns, essentially permanent. Consider the timeline. In October 2022, Nvidia was blocked from selling its H100 chips to China. The company responded by designing the H20. In October 2023, the H20 was restricted. Nvidia is now working on lower performance chips for China, but analysts expect these to face restrictions within 18 months as well. This is an escalating cycle, not a temporary disruption. The dividend stability problem for retirees. Here's the specific concern for someone age 55–65 with Nvidia as a core holding. Even if the stock price doesn't crash immediately, the company will face margin compression and cash flow challenges that make dividend increases impossible, and eventually, cuts likely. Let's walk through the math. Nvidia's gross margin on data center products is approximately 70%. If China revenue drops permanently from $15 billion to $2–3 billion, the company loses roughly $12 billion in gross profit annually, approximately $8.4 billion after tax impact. That's not chicken feed. For a company with current free cash flow of roughly $28 billion annually, a loss of $8.4 billion in after-tax cash flow represents a 30% reduction. Historically, when semiconductor companies face 30% cash flow reductions, dividend growth stalls immediately, and cuts follow within 2–3 years. Look at Intel as a cautionary tale. Intel's dividend was $5.60 per share in 2020. In 2023, facing margin pressures and capacity questions, Intel cut its dividend to $1.40. For a retiree counting on $15,000 annually from Intel shares, that represented a 75% income cut with no advance warning. Nvidia faces similar risks. The counterargument. AI demand elsewhere. Bull case investors argue that Nvidia's non-China AI demand, particularly in North America and Europe, is growing so rapidly that China revenue loss is immaterial. They point to the surge in demand from Microsoft, Meta, Amazon, and Google for training and inference chips. This argument has some merit. Meta's capital expenditure budget reached $50 billion in 2024, driven largely by AI infrastructure. Google is building new data centers explicitly for AI workloads. This demand is real and substantial, but here's the problem with this counterargument. That demand was already baked into Nvidia's growth projections. The company wasn't sitting around with excess capacity waiting for U.S. AI companies to show up. Wall Street's $200 plus price targets for Nvidia assumed China revenue plus U.S. AI boom. Now Nvidia has to deliver all of its growth targets with one hand tied behind its back. Managing partners at technology-focused investment firms have noted that even with robust U.S. demand, Nvidia is facing a replacement cycle compression, meaning customers are buying chips and holding them longer, reducing repurchase frequency. This means growth rates for 2025-2027 will likely be 15-25% rather than the 40-60% rates the market has priced in. Case study. How this plays out in your retirement portfolio. Let's model a realistic scenario for someone age 58 with $800,000 in retirement savings, with $200,000, 25%. In Nvidia stock purchased at an average cost of $180 per share. Current situation. Nvidia trading at $145, down from $190 peak, meaning the position has lost $9,000 in value. The retiree hasn't taken this hit personally because they haven't needed to withdraw yet. Scenario A, bull case. Nvidia recovers to $200 over next 18 months as U.S. AI demand justifies growth rates. The investor sees the position recover and feel confident. Scenario B, bear case. China restrictions worsen, margin guidance drops 300 basis points. Institutional investors rotate out of Nvidia into diversified semiconductor companies. Stock settles at $95-105 over 18 months. The investor now faces a $200,000 position that's worth $110, $120, If they need portfolio distributions to start in 24 months, age 60, they must harvest this loss or reduce overall spending. The median retiree cannot absorb a $90,000 loss. A $90,000 loss translates to roughly $4,500 annually in retirement income, using 5% safe withdrawal rate. That's the difference between comfortable retirement and cutting back on healthcare, travel, and helping grandchildren. What this means for your dividend strategy if you're currently in your 50 and holding Nvidia as a core position with expectations for 20-30 years of capital appreciation to fund retirement. You need to stress test this assumption immediately. Specific action items. 1. Calculate what happens to your retirement income if Nvidia stock drops 40% and remains flat for 3 years. If that scenario reduces your retirement income by more than 10%, your position is oversized. 2. Examine whether you're conflating Nvidia's past performance, 65% annual returns, with future performance. The company cannot grow 65% annually without China. The math is simply impossible. 3. Consider rebalancing into semiconductor diversification. AMD, Taiwan Semiconductor Manufacturing Company, TSMC, and Broadcom offer exposure to the AI theme with lower China sensitivity. TSMC, while not immune to China issues, derives less direct revenue from mainland China than Nvidia. 4. Model your portfolio with Nvidia at $100, $120, and $140 price points. If your retirement breaks at $120, you need to reduce exposure now rather than face a forced sale later. The 90-day timeline. Why 90 days specifically? Because in the next quarter, Nvidia will either issue guidance suggesting China revenue stabilization, which could support the stock price, announce further China revenue declines and reduced guidance, which could trigger a significant sell-off, announce a strategic pivot, such as acquisition of smaller AI chip companies or new products for U.S. only markets. Any of these events will create